Yeah. Good evening, all, once again. So, our today's agenda is AS5, Accounting Standard number 5, which is an important accounting standard from the real life point of view, as well as exam also. Exam, you can get a question from AS5, but it is more important from your real life point of view. And when I say AS5, I would simply say that AS5 is equal to AS5 is equal to profit and loss account. Sir, why are you saying so? The biggest reason behind this is, sir, AS5 is a specific accounting standard which is made for the presentation and disclosures of certain items of incomes or expenses which form the part of your profit and loss account to calculate the net profit or loss for a particular period. So technically, I would say that AS7 is AS5 is more of a presentation and disclosure related standard. So here we are not going to learn the recognition criterias. We are not going to learn the valuation criterias or the measurement criterias as you call them. So here our major focus will be on how to present certain items in the profit and loss account. That is the major objective of this topic. Followed by, we will also be learning the treatments with respect to changes in accounting estimates, which is new for you people, as well as we will also be learning treatments with respect to changes in accounting policies. If I am not wrong, changes in accounting policies we have already covered in AS1. If you remember, AS1 we already saw what are changes in accounting policies, when can you change. There were three reasons. If it is required by law, you can change. If it is required by AS, you can change your policy. Or if the management is of the opinion that a change would give a better presentation, then you can change, right? And if you change your accounting policy, you have to give compulsory disclosures. Disclosure with respect to the fact of change should be disclosed, the reason of change should be disclosed, and thirdly, the quantifiable effect if it is ascertainable. So quantifiable effect was not compulsory. If it can be ascertained, then only you need to disclose it. If it cannot be ascertained, then no need to give a disclosure, right? Remembering in AS1, the same point will be covered again. So sir, here, the major focus is on the presentation of the profit and loss account, followed by changes in accounting policies and changes in accounting estimates. Now, sir, when I talk about net profit or loss for the period, or when I talk about your profit and loss account, in your profit and loss account, you find the net profit or loss for a particular period of time. And generally, in our case, in India, we make a profit and loss account for a period of 12 months. How many months? 12 months. So technically, whatever expenses or whatever incomes fall within this 12 months period are shown in the P&L account. Yes or no? Right? That is why we have these adjustments because of the prepaids and outstandings coming in. That is the only reason why we have these adjustments, right? And I can also say that, sir, there is a possibility. Now, I'm asking you this. I'm asking you this. Is there a possibility that any item of income or expense which is actually not belonging to this 12 months period, but it is appearing in your profit and loss account? Is it possible? Means I'm talking about a certain item of income or expense which does not belong to this 12 months period. Can it appear in your profit and loss account? One answer I got no. One answer I'm getting yes. Deferred expense, yes, no, yes, no. Anybody would like to answer this? Can raise your hand and they can answer me directly. Yes, Sutarsha, you can answer this.
So prepaid expenses are which are pertaining to the next year are coming in the profit and loss account, right, sir?
But that we subtract, na madam, we subtract minus prepaid
Yeah,
expenses and we put it on
right.
the balance sheet asset side. So my question is, can a particular income or expense can be debited or credited in the profit and loss account, even if it is not with respect to this year. Can that happen? That is my question.
Then it is no, sir.
No. Okay. Okay. Yes, Aditya.
Hello? Yes,
Yes.
my answer is yes, because, for example, any preliminary expenses which is incurred before the incorporation of a company, and then
Hmm.
they're in the subsequent they're written off in the subsequent financial years, even though they are not related to that particular financial year.
So now whatever you said with respect to a preliminary expenses, that I could say as a deferred expenditure. And
Yeah,
it's a
deferred.
deferred expenditure. What is the logic is you're going to get a benefit over the period of time. That is why you write off it equally over a period of 5 or 10 years as the case may be. So
Yes.
technically the logic is what you're debiting to the P&L because your benefit is deferred.
Yeah. Oh,
So you are getting the benefit in the
okay.
current year also. That is why you're writing off some part of the preliminary expenses in this year. So yes, I would say that it is belonging to the current year, hence it is debited.
Yes, sir.
I cannot say that it does not belong to this year. See, when I say a deferred expense means what? I'm going to get a benefit over a period of 5, 10, 15 years as the case may be.
Yeah.
So since I'm going to get a benefit for 5, 10 or 15 years as the case may be, I'm going to debit it every year. So when
Yes,
I
yes.
debit it every year means I'm getting the benefit and it belongs to this year only. That part which is debited belongs to this year.
Yes.
Amrita. So your answer is not correct with respect to that. Amrita.
Sir, profit and loss account is prepared for a specific period. So
Correct.
whatever income or expense that we incur or not incur during the particular
Mhm.
year should be recorded, sir. Whether we incur or not, but it should be recorded for that particular period.
Fine, that is what I said. But my question was, is there a possibility that an income or expense which does not relate to this particular year can also become in the P&L account? That is my question. Whatever you
No,
said is correct. It was the
no,
same thing
sir.
I repeated.
No, sir,
No, your
because
answer
it
is
is
no.
prepared for only a specific period, so that it should be recorded only for that specific period, sir.
Okay, okay, fine, fine. Now I'll give you one answer, sir. Yes, sir. Recovery of bad debts of last year. No, sir. It is recovery of bad debts. That is absolutely correct. But in such recovery cases, we don't pertain it to any particular year. Recovery of bad debts is considered as the current year item only because it is your income or it is your revenue when it is actually collected. So it what in whichever financial year it is collected, it becomes a revenue of that year. Good attempt, but sir, no. Now I'll give you an answer for this. Let us go to CA Foundation again. 3-4 months back, you did a chapter called as rectification of errors, if I'm not wrong. Correct? In that chapter, you learned that your errors can be rectified in 3 stages. Your errors can be rectified in 3 stages. One, before preparation of the trial balance. Second, after preparation of the trial balance. And third, after preparation of the final accounts, that is in the subsequent financial years. Right? That is my point. Sir, if an error or omission took place in the previous financial years and those arise in the current year for rectification, then where will that incomes or expenses be recorded? Sir, it will be recorded in the profit and loss account only, but with a separate disclosure and a separate presentation. They are called as prior period items. So yes, in my profit and loss account, technically, all the incomes and all the expense relate to this specific period only for which I prepare my P&L account. But sir, there are prior period items which may appear in the profit and loss account. And these prior period items don't belong to the current year. They are technically the errors or omissions of the previous financial years, which now arise for rectification. And if you rectify them, it is going to affect your incomes or expenses of the current year. So yes, it is possible. Right? So this AS will also cover the treatment with respect to, prior period items. Yes, you learned that it is adjusted in profit and loss adjustment account And in your CA foundation, you learned that profit and loss adjustment account is eventually adjusted against the proprietor's capital account. But sir, if I talk about a company, there is no proprietor's capital or anything. And in real life also, it is whether it's a proprietorship or a partnership firm, it has to be getting adjusted in the P&L account only. See, when you adjust directly through the capital account, it is as good as you adjusting in the P&L only. Because see, when you adjust in the P&L, if it is increasing your income, so it will increase your net profit and eventually your capital balance will increase because net profit will go and get add up in the capital account only. So these people did not show it in the P&L, they directly added up or subtracted from the capital account. But in real life, P&L adjustment is a part of your P&L account and it has to get merged with the P&L account only. So technically, why they took it in the P&L adjustment? Only because they have to show it separately from the normal P&L items. That is why they took it in P&L adjustment. I hope you're getting this point. Right? So let us have a look at the objective of the standard. Just a minute. I'll just collect my pencil. Yeah. Now, this chapter has a big objective. Before the objective, I'll just read out the name of the topic. AS5, net profit or loss for the period. That is nothing but your profit and loss account. Prior period items, which is again a part of your P&L account, and changes in accounting policies. Changes in accounting policies we have already covered in AS1. Followed by this, AS will also cover changes in accounting estimates, which is something new for you people. So that we'll be discussing out. Now, this AS is applicable to all the 3 levels of entities. Applicable to all the 3 levels of entities. And this is a group 2 accounting standards. So you can see over here, I've written AS5 group 2. So this is a group 2 accounting standard applicable to all the 3 levels of entities. And the simple common sense behind it is, sir, every enterprise will prepare a profit and loss account. Correct? And if everybody has to prepare a profit and loss account, they have to follow the presentation and disclosure requirements of AS5. So let us have a look at the objective. The objective of the AS5 is to prescribe the classification and disclosure of certain items in the statement of profit and loss so that enterprise prepares and presents such a statement on a uniform basis. Now, when I say AS5 prescribes classification means, sir, our AS5 is dividing our P&L account into 3 classifications. You can see on your screens 3 classifications: profit and loss from ordinary activities, extraordinary activities, and prior period items. So technically, your P&L account says that AS5 says that if you are preparing a profit and loss account, please classify items as ordinary items, as extraordinary items, or as prior period items, as the case may be. Right? That is what is prescribed in AS5, which refers to classification and disclosure of certain items in the profit and loss so that all enterprises prepare and present such a statement on uniform basis. And this enhances the comparability of the financial statements of an enterprise over the time with the financial statements of the other enterprise. Now you can compare your financial statement with yourself over a period of time, means when you make a comparative profit and loss account. So you can compare your 3 or 4 years P&L, or you can compare your profit and loss account with the profit and loss account of the other enterprises also, because uniformity brings comparability. We have already seen in the introduction topic. Accordingly, AS5 requires the classification and disclosure of extraordinary and prior period items and the disclosure of certain items within profit or loss from ordinary activities. Now you have to learn something called as something new for you, that is extraordinary items and prior period items, which we'll be learning in detail in the next 10-15 minutes. Right? Ordinary items are very simple. This will not take much time, but the time consumed will be with respect to extraordinary and prior period items. It also specifies the accounting treatment for changes in accounting estimates and the disclosures to be made in the financial statements regarding changes in accounting policies. Now, can I say disclosures to be made in the financial statements regarding changes in accounting policies I've already covered in AS1. I will revise it once again. But new thing for you is accounting treatment for changes in accounting estimates. So here first we will be learning what are accounting estimates. Can these estimates be changed And if these estimates are changed, what should be the treatment? Means treatment as in where it should be classified, as an ordinary item or as an extraordinary item. That is what we are going to learn over here. So I will divide this topic now into 5 major areas. First is net profit or loss from the ordinary items. Second, extraordinary items. Third, prior period items. Fourth, accounting estimates. And fifth, changes in accounting policies. So these are the 5 areas in which we will now be discussing the accounting standard. Right? So any person having any query with respect to objective part or whatever I talked about till here, anybody, you can use the raise hand option and ask your queries accordingly. But isn't it recording? Okay, that is done. Okay. I'll wait for 10-20 seconds more. If no hands are raised, then I'll start further. So what's the difference between accounting policy? We will talk about it because I have not taught you what are accounting estimates. So once I teach you estimates, you will automatically understand this. You will automatically understand the difference between accounting policy and estimates. So let's wait for some time. So these notes are different from the PDF I got from JK Shah. Sir, this PDF notes are also updated on the link which is given in the timetable. So you can download it over there. These are the, the summary notes that I have prepared. Summary notes as in this is actually not summary. This is full accounting standard only, but in a proper chart form of presentation and all, which makes learning more understandable. These are available, sir. You please check the timetable. In the timetable, there is a link given where you will be taken into the Google Drive for downloading notes. In that, there is a folder AS summary notes. In that, you will find all these copies. Yes, Dikshit.
Sir, I didn't understand the objectives of accounting standards, sir.
What did you not understand, sir?
I didn't understand in that objectives what were going. I didn't understand for objectives, that one only. I understand profit and loss for the period, but I didn't understand objectives.
So that is, sir, the objective of this standard is how to prepare P&L account. Means how to show the items in the profit and loss account, whether a separate disclosure is required, or you can combine items and show it, or how to present these items. So for that, what you have to do is classify your P&L account into 3 parts: ordinary items, extraordinary items, and prior period items. That is what we are going to learn now, that how to present these. So objective is very simple. How to prepare P&L account is what the object is.
Okay, thank you.
The preparation and presentation of profit and loss account is what the objective is.
Objective is in the presentation of profit and loss accounts is there. Okay, sir.
Objective is how to present and prepare your profit and loss account. So objective itself, you can say that yes, presentation and disclosure is the objective of the standard. This standard is purely made for presenting and disclosing certain items of the profit and loss account. And accounting estimates, accounting treatment, and disclosures for accounting policies. Now, disclosures for accounting policies we already learned. So we have to discuss about accounting estimates also. Yeah, I already told this is a group 2 accounting standard. Yes, this is advanced accounting. Yes, group 2 means it is advanced accounting. Group 1 is accounting. Right? Anything else, Dikshit? Or shall I mute you?
No, sir. I understand.
Okay, thank you, sir. Now let us start with the net profit or loss for the period. That is nothing but your P&L account. What it says, all items of incomes and expenses which are recognized in a period should be included in the determination of net profit or loss for the period unless an accounting standard requires or permits otherwise. Means technically, whatever incomes or expenses you have incurred for a particular period, those incomes and expenses should be considered while calculating the net profit or loss for that period. But sometimes it may happen that certain accounting standards may require that these items should not come in the P&L account right now. It has to be deferred. Now, the best example is deferred expenses. So whatever expense you incurred, complete expense don't come in the same year. Only certain part of that expense come in this year, and balance you carry forward it to the future. And you write it off in the future period. Right? This is what everybody of us, we know. See, whenever we are preparing a profit and loss account and calculating a net profit or loss for a particular period of time, generally in our case, 12 months, all incomes and all expenses with respect to those 12 months should be taken care while preparing the P&L account. That is what everybody of us know. Further, they say the net profit or loss for the period comprises the following components, and each component of which should be disclosed on the face of the statement of profit and loss. Face of the statement of profit or loss means in your profit and loss statement itself. Because your profit and loss account statement is also backed up with certain schedules. If you have seen CA Foundation company accounts, you might have seen how the Schedule 3 balance sheet and profit and loss account is made. And you might have been shown over there with every balance sheet and every profit and loss account, there are so many schedules backed, which gives you the detailed explanation of how you arrived at certain figures. But your actual profit and loss account is called, the items which are shown in your actual profit and loss account are called as face of the P&L. Right? So let us now divide our profit and loss account into three major areas. The three classifications of P&L account. First, profit or loss from ordinary activities. Then we'll go for extraordinary. Then we'll go for prior period. Now, please understand, sir, what do you mean by ordinary activities? Now, sir, here I am talking about those incomes or expenses which arise in the ordinary day-to-day activities of our business. Means these are purely operating incomes and operating expenses. And I can also say the frequency of occurrence is too high. Means they are recurring in nature. They are recurring in nature. I will repeat my point. Sir, ordinary items are items of incomes or expenses which arise in the day-to-day business activities. And they are directly related to the operations of the business. Or I can say they are operational incomes or operational expenses. Right? They are purely and directly related to your day-to-day operations. And all such items are called as what? Ordinary items. Example, rent, salary, electricity bill, commission charges, sales, purchases. These are all what? Ordinary items. Right? So what the definition is, any activities which are undertaken by an enterprise as part of its business, and such related activities in which the enterprise engages in furtherance of, incidental to, or arising from these activities. So in short, I can say incomes or expenses related to the day-to-day business activities or operational activities. As simple as that. Because that is the book definition, and book definitions are always a bit dangerous. So we will be talking in a very simple terms. And sir, in simple terms, I can say that ordinary items are nothing but incomes and expenses which are directly related to the operational activities or your day-to-day activities of the business. Right? Now, please understand, as per AS5, your ordinary activities do not require any separate treatment. They have to be recorded normally in the profit and loss account. Means no separate presentation is required. No separate disclosings are to be given with respect to them. Means in the notes to accounts need not disclose separately with respect to these items. Unless they are exceptional items. Unless they are exceptional items. Means your ordinary items can be normal items or they can be exceptional items. If they are normal items, no separate treatment. Normally record in the profit and loss account. right? No separate presentation required, no separate disclosure required. Record it normally. That is why they are called as normal items. The best example will be salary, wages, rent, purchase, sales, etc. But sir, there are certain ordinary items. There are certain ordinary items which are heavily material for your enterprise, which are heavily material for your enterprise because of the nature of the transaction or the size of the transaction with comparison to the size of your enterprise. Means they can be either qualitatively material or they can be quantitatively material. So if they are qualitatively or quantitatively material, then I can say that these are ordinary but exceptional items. Ordinary but exceptional items. And if it is an ordinary but exceptional item, then a separate presentation and disclosure is required. Reason, it is material. Reason, it is material. So these are all items which are ordinary in nature. When I say ordinary means what? It is your day-to-day business operational item. It is a day-to-day business activity item. But the size and nature is huge. The nature of the transaction or the size of the transaction is big as compared to your organization. So it is material for you. And since it is material for you, a separate presentation or disclosure is required. I hope you're understanding my point. Right? So now I am taking you towards the classification of ordinary activities or ordinary items. Your ordinary items will be divided into two parts. Yes. First, normal items. Normal items means normal rent, salary, stationery, wages. So since it is normal people don't have any separate disclosure or separate presentation requirements. Normal people will have a normal life, means normally recorded in the P&L account. Right? No problem at all. But when I say exceptional items means, please understand the definition, when items of income and expenses within the profit or loss from ordinary activities, means these are technically your ordinary activities only, but are of such size, nature, or incidents that their disclosure is relevant to explain the performance of the enterprise for the period, means that it is material. And what are materials? Sir, material items are those items which can change the decision making of an enterprise. Right? That is why they say that it can explain the performance of the enterprise for the period. The nature and amount of such items should be disclosed separately. So you technically have to give a separate disclosure, a separate presentation for all the exceptional items. And these exceptional items are ordinary in nature, but their size and nature or their happening is very much material for the enterprise, which can change the decision making of the enterprise. I have written few examples over here. The first example is writing down the inventories to NRV. So if you remember, you have already done this topic called as inventories in CA Foundation. And some people we also covered AS2. So everybody knows that inventories at the balance sheet date are valued at cost or NRV, whichever is lower. So if the NRV is lower than the cost, can I say you have to write down your inventories to NRV? So when you write down your inventories to NRV, it's a loss, right? And such loss is considered as an exceptional item, and it has to be shown separately in the profit and loss account. It has to be shown separately presented in the profit and loss account. Point number one. Point number two, disposal of fixed assets. So when you dispose of your fixed assets, means when you sell off your fixed assets, any profit or loss arising from the sale of such fixed assets is also considered as what? Exceptional item. Then disposal of long-term investments, means any profit or losses arising on the sale of the long-term investments, not the short-term, because you have learned investments are classified into long-term and short-term. So with respect to long-term investments, they will be shown as an exceptional items. Then litigation settlements. Litigation settlement means when you settle a court case. When you settle a court case, it can either be a revenue for you or it can be an expense for you. So whether it's a revenue or an expense, it will be recorded as what? An exceptional item. Now, some people will say that, sir, these court cases and all, sir, they are ordinary items. Yes, because it is related to either it is related to your business activities only. Because if it is your personal court case, means a murder case is going against you, then why will you show it in your books of accounts? Right? Technically, that is personal in nature. But if you a court case has been filed against you for providing inferior quality of goods, then can I say it is related to your operational activities only? So it is an ordinary activity, but only exceptional in nature. Why? Because the litigation itself, the nature of the transaction is something different. It is qualitatively material. Right? You can also give the example that if you remember, I gave you the example of speculative transactions in AS1. If you remember, when I was teaching about qualitative materiality. So the speculative transactions can also be put under exceptional items because it is different from the normal business operations, right? It is qualitatively material for us. It is my business activity only, but I have started a new activity. So as of now, something different. I can put it as an exceptional item, right? So simple thumb rule, sir, ordinary items can be normal items or can be exceptional items. If it is an ordinary normal item, no. Technically, exceptional is non-operating. No, that is absolutely wrong. It is absolutely wrong. You did not get the point itself. If you read this carefully, items of incomes and expenses within profit or loss from ordinary activities only. So ordinary activities means what? It is operating activities only. So your exceptional items are your ordinary items, but the only thing is their size and nature is very material for you, or their happening is very much material for the enterprise. So that is the only reason why a separate disclosure is required for them. So please don't go in a wrong sense that exceptional items are non-operating in nature. No, these are your operating items only, but they are heavily material for you. That is why you require a separate disclosure for them. So even I can say one thing, that your salary can also be considered. Your salary can also be considered as an exceptional item if the amount of the salary paid during the year is too big. Means if your total expense for the year is 10 lakhs, and you have paid 4 lakhs salary only in that. So 40% of your total expense is salary. Can I say the amount is huge? So even salary will be requiring a separate disclosure. Even salary is a normal item, but since the amount is too high, you can give a separate disclosure for salary also. Yes, Sujit.
Good afternoon, sir.
Good evening.
Good evening, sorry. Sir, you said that ordinary items are of highly recurring nature, and it is means in day-to-day business.
Yes, related to your day-to-day business activities.
Okay. But you said that exceptional items are, for example, disposal of fixed assets and litigation settlement. They don't occur in means not highly occurring, right? Recurring, right?
They don't occur. Because every now and then you don't settle a litigation. But sir, when you are settling a litigation, can I say it is related to your business activities only?
Yes.
Right. So that is why it is considered as an ordinary but exceptional item.
Thank you.
Right. It is your ordinary activity only, but the point is they are considered as exceptional. So if this litigation settlement has lower amounts in nature, so it can be considered as normal. No. See, a transaction, even if the amount is lower, but if the nature of the transaction is material, still it is exceptional only. Because materiality can be either through nature of the transaction or it can be through the amount of the transaction. That is why we have given materiality into two types, quantitatively material and qualitatively material.
So what
Yes,
is the
Ritika.
difference between normal items? Now, what is the difference between normal item and exceptional items? Like salary is like both. You're telling that salary
Madam,
could
you
be
please, I would
accommodated.
say for a minute, you please read this paragraph. For a minute, read this paragraph slowly and then again come up. Just read the paragraph slowly for a minute and then come up. Again, raise your hand.
Sir,
Yes,
could you
Sutarsha.
please give
Yes.
some examples of speculative transactions?
Yes. Now, see,
Example.
speculative transaction. If I am doing transactions in speculative, right?
Yeah.
And that is also one type of business for me. If I'm doing some speculative transactions also, that is also a business transaction for me. And since the nature of the transaction is material, it is something different from what I was generally doing, I can put it as an exceptional item also.
Okay. Speculative transactions are like the stock market investment.
Yes, yes. Stock market transaction, futures and options, day-to-day settlement, BTST transactions, buy today, sell tomorrow transactions, F&O transactions.
Oh, okay, sir.
Or
Fine.
you buy today morning and sell today in the afternoon itself. So those are called as what speculative intraday transactions.
Okay, sir. Thank you, sir.
Right.
So I understood.
Got the point. What the difference?
Okay.
Exceptional items are only different from normal items because of the size and nature. That's it. Their size and nature is something which is material for enterprise, and the happening of these items will have an impact on your decision making. Right? Then only these are exceptional.
Thank you, sir.
Yeah, welcome. In any, just a minute, sir. Any transaction related to operational activity can be normal or exceptional. Exceptional in case of either qualitative or quantitative materiality. Is it correct? Yes. Yes. Material. Transactions which are heavily material for an enterprise can be considered as an exceptional item. And it can either be through with the nature of the transaction or with the amount of the transaction. That is why I said, even if you have paid a huge amount of salary, can be considered as an exceptional item for the purpose of presentation and disclosure in the financial statements. That is in the P&L account.
Yes. Hello, sir.
Yes, sir.
Sir, just wanted to clear, like, suppose if a transaction, if a item is not quantity-wise material, but if it is quality-wise material to the organization, so it will be considered as a extraordinary item.
Exceptional item, sir. I have not started extraordinary items of
Sorry, my bad, my exception.
Yes. See, just have a look at the definition. See, stick to the basics. Now, what is the basic definition stating? When items of incomes and expenses within your profit and loss from ordinary activities. Means these are your ordinary activities item. Means it can be an ordinary income or an ordinary expense, but its size and nature or incidents that their disclosure is relevant to explain the performance. Now, when I say that certain items are required to explain the performance of your enterprise, means they are material, sir. See, if I have sold scrap for 500 rupees, it is immaterial for my enterprise. But if I have sold scrap worth 50 lakh rupees, then it becomes heavily material. Right? Material because of its size. Size is nothing but amount. Nature means the quality of the transaction.
Okay, so,
right?
So both condition, nature and size should satisfy for
anyone.
the
See,
exception.
anyone. It is nature, size, comma nature, or its incidence, means it's happening, is very much important to make others understand about your financial statements.
Okay, got it, sir.
That is why that is why we say that it is material.
Yes, got it, sir.
Right? Yes, Gunjan.
So ordinary exceptional items are to be separately disclosed, right? So what do you mean by separately disclosed? Like how? Separately disclosed means they have to be given a distinct presentation as compared to the other items in the P&L. And I'll show you one. See, this is one P&L statement that I've drafted. I'll show you. So I'll tell you how and where it has to be presented. But as of now, you please understand that it has to be given a distinct recognition. I mean, it has to be shown separately from the other items. Yes, and someone also asked about speculative transactions. So that is nothing but ordinary exceptional items, no?
Depending upon the nature of your business. See, if you are doing only trading of shares and securities, then sir, it is nowhere exceptional.
Okay.
Right. But if you are not doing any trading or speculative transactions with respect to shares or securities, but you have started to do so. So at least for 1 or 2 years, those transactions can be considered as an exceptional item.
Okay. Else it will be normal item.
Yes, because if you're normally doing these transactions only, then these are not exceptional items for you.
Okay.
Unless the size is too much high, because then nature becomes normal.
Yes, sir.
Size means that is amount. If you're earning exceptional profits from speculative transactions, then definitely you have to give a separate disclosures from it. Means from my normal day-to-day business activities, I'm earning 1 lakh rupees, but by doing speculative transactions, I'm earning 5 lakh rupees. Then in that case, the size of the transaction is too much material for the enterprise, so it can be considered as an exceptional item.
Oh, okay, sir. Thank you, sir.
Yeah, welcome. Is provision for bad debts a normal item? Yes, it is. We'll discuss about provision for bad debts. Just hold for some times. Just wait for around 15-20 minutes. We'll be discussing about provisions for bad debts very soon. Now let us go for the next part of the topic. That is the second classification of profit and loss account. That is with respect to extraordinary items. Now, sir, please understand. Extraordinary items are distinct or separate from your operational activities. Means it is nowhere related to your day-to-day business activities, and they are non-recurring in nature. They don't recur every now and then. Means I can say they appear once in a blue moon. Can you see a blue moon every day? No, sir. Once in a while we see a blue moon. So these transactions also occur once in a blue moon, and they are nowhere related to your day-to-day business activities. It is completely different. That is why we call them as extraordinary items. Right? Now, for simple example, we can say if a guy always proposes a girl and the girl always rejects him. So that is ordinary for that guy, taking a rejection. But on 14th February, somehow some girl accepted his proposal. So can I say that day it is extraordinary thing happening for him? Because till now he might have proposed 15-20 girls and everybody has rejected his proposal. But today, on 14th of February, some or the other girl, she accepted the proposal, because we say that love is blind, right? The love was really blind, so she accepted the proposal. So on 14th of February. So on technical basis, I will say that that day was extraordinary for him, because in the normal activities he always got a rejection, but today he is getting an acceptance. So technically that is extraordinary. So what AS5 requires? Sir, AS5 says that if any extraordinary item appears in your profit and loss account, please give a separate disclosure and presentation of it in the profit and loss account in such a manner that its impact on your net profit or loss can be clearly perceived or can be clearly calculated. Means when a user goes through your profit and loss account, the user should come to know that, acha, before the extraordinary item, this is your profit. After the extraordinary item, this is your profit. In that manner, I am saying you have to give a disclosure. Best examples for extraordinary items, sir: losses by fire, by theft, or by natural calamities, or by enemy attacks, any losses in those kinds. Then you have received government grants. Government grants, whatever is received becomes refundable, right? These are certain examples of extraordinary items, because these are not directly related to your day-to-day business activities. These are completely distinct. Means some transactions happening in your enterprise which are not related to your business or not related to your operations. Now see what it says: income or expenses that arise from events or transactions that are clearly distinct. Please underline the word clearly distinct from ordinary activities of the enterprise, and therefore are not expected to recur frequently or regularly. That is why I said these are non-recurring in nature. Extraordinary items should be disclosed in the statement of profit and loss as a part of net profit or loss for the period. Means they should form the part of your P&L account, right? But the nature and the amount of each extraordinary item, the nature and the amount of each extraordinary item should be separately disclosed in the profit and loss statement in a manner that its impact on the current profit or loss can be perceived. So technically, you have to give a separate disclosure of the nature and amount. Nature and amount means what type of income or expense it is. That has to be separately shown in the profit and loss account, followed by its amount. And you have to show it separately so that if a user goes through your financial statements, then he or she can understand that before these items, this is your profit. After these items, this is your profits. Sir, what about annual general meeting expenses and expenses made to arrange for business locations? Sir, these are all operative. AGM is a part and parcel of your business activity only. So these are all your normal items only. Certain examples of your extraordinary items I've put over here. Loss due to earthquake, or you can take loss by fire or loss by theft, extraordinary items. Attachment of property. Now, what do you mean by attachment of property? Now, you might be aware that if you don't pay your income tax due, or if you don't pay your GST dues, or you don't pay your property taxes, government has the authority to attach your property. They will attach your property, they will sell off your property and recover the dues. That is called as attachment of property. Government grants becoming refundable. We'll be learning about refund of government grants in detail when we do AS12. But sir, one simple point I would like to raise. If you're getting a grant from the government, it is always subject to certain conditions. If you don't fulfill the conditions, the grant becomes refundable. Conditions will be completely depending upon the agreements between you and the government. Then loss due to fire, loss due to enemy attack. These are certain examples with respect to extraordinary items. Yes, loss in transit are also extraordinary items, whatever mode of transport it is. Loss in transit is also extraordinary items. See, whenever you see extraordinary items, these are distinct from your normal business items or normal business activities. Yes, Sujit.
Sir, it is said that loss due to earthquake, loss due to enemy attack, they can simply put abnormal loss, right? Is there any difference?
Maybe yes. No, sir. Abnormal losses are all these items. But I have given specific. If I write only abnormal loss, then again it will be a confusing.
Okay.
That is why I've given in detail.
Okay, sir.
Right. Donations are not a part of your P&L account. So please don't ask. Donations are not a part of your profit and loss account. That is a charitable activity that you're doing. It does not find a place in the P&L account. So since they don't find a place in the P&L account, it cannot be ordinary or extraordinary. Now, please, if you don't understand government grants become refundable, please hold. You will be learning it in detail in AS12. Just understand whenever you are receiving a grant, the grant may also become refundable. Means whatever grant government paid you, government can demand a refund. Now, why will government demand a refund? We'll all discuss in AS12 because I don't want to discuss AS12 in AS5 now. Yes, unmute. K13.
Sir,
yeah.
income
Dhara. Dhara, you're not audible clearly.
Refunded will be.
Madam, income
Sir,
tax
income
refund.
tax refunded.
No, income tax refund don't find a place in the P&L account. It is adjusted directly through your provisions and your advance accounts. So it don't find a place in the P&L. So no way of discussing it. Right? Only the items which fall in the P&L account will be either ordinary or extraordinary or prior period items. The items which don't fall in P&L account, no need of discussing whether they are ordinary or extraordinary. Yes, 8422.
Sir, for a business dealing in furniture and textiles, sir, if they use their business for steady transactions or share marketing transactions, it is an extraordinary item, sir, because it is clearly distinct from their trading activities and ordinary items.
Yes. But if they are continuously doing those transactions, then it also becomes operating for them. So at least only for 1 or 2 years, it can be considered as extraordinary. But after that, since you are dealing it on a very regular basis, then it becomes an ordinary activity.
Okay, sir. Thank you.
Yeah. Yes, madam.
Sir, loss due to transit is not relating to operating activity because bringing goods inside is daily basis only.
But my simple answer is then loss. See, when I say loss in transit, that is because of any accident or any as such activity. Now, is this happening of accident or something is related to your business? Means, is your business of doing accidents on road, that you deal in doing accidents on road? You take money from people and do accidents on road? Technically, no. Technically, no. What is your operations? Your operation is manufacturing activities and so on. So any such abnormal items taking place in your enterprise are distinct from your day-to-day activities.
Sir, for example, if we are bringing petrol, we obviously know some loss will be there due to transit.
That is normal loss, madam. Normal loss is not accounted only.
Okay.
Normal loss is not accounted only, and abnormal losses are accounted as an extraordinary item.
Okay, sir.
Right? Yes, Vansh.
So you just told that if any organization indulges in goods and services, they don't do accidents every day. So similarly for litigation settlements, they don't indulge in court cases every day, no sir. So how can it be day-to-day activity? Like how can it be then ordinary activity?
Sir, see, I'll tell you one thing. When a litigation is taking place, a litigation is taking place with respect to your business activities only.
Yes, sir.
Correct. If you have supplied inferior goods to any of your customer and customer sues you in the court of law, so this court case has arisen because of any of your ordinary items only.
Okay, yes, sir.
So that is the reason why we consider it as an ordinary item.
Okay, so because of any ordinary business transaction, the case happens. So that it's an ordinary item.
Correctly.
Got it.
But in the extraordinary case, what is the thing is, it is abnormal in nature. Such items don't happen, and your activities are completely different from these abnormal things which took place. That is why they are considered as what? Extraordinary item.
Thank you, sir.
Right? Now, please understand one more thing. What is extraordinary or what is ordinary for you completely depends upon the nature of your business. Means, if a particular transaction is ordinary for you, but the same transaction can also be extraordinary for me because of the nature of my business, or some items which are ordinary for me may be extraordinary for you. So please understand, when we say that this is extraordinary or this is ordinary, completely depends upon the nature of our business. Now, as I told you, as one person asked me, sir, if we are dealing in furniture, we are trader in furniture and we did some speculative transaction. Now, these speculative transactions are nowhere related to my business activities. They are completely distinct. So these speculative transactions will be considered as an extraordinary item for that furniture dealer. But say, sir, I am a trader in shares. My business is trading in shares. And if I am earning speculative profit, then it is ordinary or extraordinary? Sir, it is ordinary. So for one person, something is ordinary. It can be extraordinary for some other person, which completely depends upon the nature of the business. I'll give you an example for this. Let us take an insurance example. Now, if you have a loss by fire, and you get an insurance claim for it, right? Now, getting an insurance claim itself is an extraordinary item. Getting an insurance claim itself is an extraordinary item because, first of all, it is non-recurring in nature, and getting the revenue from the insurance company is not your day-to-day activity. Am I correct? Right? But on the other hand, think from the insurance company's point of view. Sir, for an insurance company, settling an insurance claim is very much normal and it is ordinary in nature. So for them, settling an insurance claim is ordinary item, but for you, receiving an insurance claim is extraordinary item. I hope you are understanding this. Right? Now, one more point I want to raise over here is, sir, insurance claims that you collect is adjusted against the value of the inventory in your P&L account. Now, if I say that you have 100 rupees of purchases debited on the P&L account, right? And what we say, 100 rupees of goods are lost. And against that, 80 rupees insurance claim you are receiving. So how much credit you give for the P&L account? Sir, entire 100 rupees is credited to the P&L because the goods are no more with you. And when you give 100 rupees of credit in your trading account, your trading account gets credited by first loss by fire and second by insurance claim. If you know the journal entry will be loss by fire account debit, insurance claim account debit to inventory. So technically your insurance claim has one presentation in your profit and loss account on the credit side. Because on the debit side, goods come in, and on the credit side, goods goes out. So 100 rupees of goods have gone out in the form of 20 rupees loss by fire, 80 rupees insurance claim. So it has a presentation in your profit and loss account, and it is shown as an extraordinary item. I hope you're understanding this, Aditya. Can you please explain why gain or loss on sale of fixed asset is ordinary and not extraordinary? Madam, sorry, no, it is sir, Nikhil. Now, please understand, when I talk about fixed assets or investments, fixed assets, when I talk about, so let us take example of fixed assets. Now, when I talk about fixed assets, can I say these are helpful in your operating activities? Are fixed assets, the plant and machinery of your factory building is used for your day-to-day operational items. Hence, it is related to your operating items only, sir. So whatever is the profit or loss on the sale of it is considered as an ordinary item only, but exceptional nature. That is why a separate disclosure is given. Now, please understand this paragraph, whatever I explained, please understand whether an event or transaction is clearly distinct from the ordinary activities of the enterprise is determined by the nature of the event or transaction in relation to the business ordinarily carried on by the enterprise, rather than by the frequency with which such events are expected to occur. Means they say that to determine whether it is an extraordinary item or not, don't only have a look at the frequency of the transaction. Please check the transaction with the nature of your business. Right? There are some litigation settlement. Now, can I say litigation settlement also happens once in a blue moon? But it is not extraordinary item, because to become an extraordinary item, it should be distinct from your day-to-day operations. Right? So please understand one thing. Don't ever judge an extraordinary item only on the basis of the occurrence, that is its frequency. An extraordinary item should be judged only on the basis of the nature of your business and the nature of your transaction. If the transaction is completely distinct from your day-to-day business activity, then it can be considered as an extraordinary item. Right? Just don't say that, sir, this happens in once 2 or 3 years. But sir, it is related to my business activity, but it happens in once or two or 3 years. So you cannot take it as extraordinary activity. It will be ordinary only. So that is what they say. To finalize whether it is an extraordinary item or not, don't only have a look at the frequency. Please check the nature of transaction with the nature of your business. That is more important. I hope you're understanding this point. And further point is, therefore, an event or transaction may be extraordinary for one enterprise, but not so for another enterprise because of the difference between their respective ordinary activities. I hope you're understanding this point. Right? So always make a thumb rule to define whether this is an extraordinary item or not. Compare it with your normal ordinary activities. If it is distinct from your ordinary activities, then only it will be extraordinary item. Don't have a look at the frequency of occurrence, because that can fool you around. Because there are certain ordinary items which occur, which are non-recurring in nature, but they are related directly to your operational activities, hence they are ordinary in nature. Now, what you have to do is, this one paragraph is actually with respect to ordinary items only. So you have to copy this paragraph I have already discussed this paragraph, but you have to copy this paragraph below your ordinary items only. What is this paragraph? If a normal ordinary item size and nature is material to enterprise, a separate disclosure will be required. Means I gave you the example of salary. If salary is 4 lakhs and your total expense is 10 lakhs, so salary covers 40% of your total expenditure. So salary's size and nature is material for enterprise. So salary should also be given a separate disclosure. So that is the point which I have written it separately over here. So you can please take a note of this point. I just hold for a minute. You can just take a note of this point. Yes, Diksha.
So, if there is a drastic increase in price of raw materials, should there be given a separate disclosure for that also?
Depends whether it is material for an enterprise or not. Because raw material end of the day purchase is an ordinary item. So if the ordinary item size and nature is important for the enterprise, then yes, you can give a separate disclosure for it.
Okay, thank you, sir.
Yeah. Now I'll talk about the next part of the topic, that is prior period items. Now, as I already told you, sir, prior period items are nothing but errors or omissions which have arisen in the preparation of financial statements of some or more previous financial years, but now you take it for rectification. Right? Now, when you rectify these items in the current year, they will find a place in the current year's P&L account, but as a prior period item. So they have to be shown separately as compared to your normal ordinary, or I would say from your ordinary items. Now, please, I'll just request one thing. When I'm explaining something, now don't send your chat queries. Huh? Just wait, because it disturbs and my link gets diverted. So once explanation is over, then you can please send your chat messages. Thus, the exceptional items include those activities which have a direct influence on normal activities. Direct influence, name, you just understand in a simple manner that it has an impact on your decision making. These are called as materiality. These are called as material transactions, which has a direct impact on your financial statements. Right? Yeah. What was I saying? Yeah. Now, when I talk about prior period items, first I'll just have a look at the definition. What it says: prior period items are incomes or expenses which arise in the current period as a result of errors or omissions in the preparation of the financial statements of one or more prior period. So technically, these are errors or omissions which took place in the prior periods, but now they arise either in the form of an income or expense, because you're rectifying the error. It can either be in the form of an income or it can be form of a expenditure. So it is arising now. Why? Because you did some error or omission in the previous financial year. Now, what you have to do is the nature and amount of prior period item should be separately disclosed in the statement of profit and loss in a manner that their impact on the current profit or loss can be perceived. So technically, for exceptional items, for extraordinary items, and for prior period items, the presentation requirements are absolutely same. They are presented in the same manner in the profit and loss account. And I'll show you how they are presented. All the three items, whether it is an exceptional item, or it's an extraordinary item, or it's a prior period item, it will have the same presentation or disclosure requirement in the profit and loss account. And I'll show you the draft of the P&L also. Just hold for 2 minutes. Further, what they say, errors in the preparation of the financial statements of one or more prior periods may be discovered in the current year. Errors may occur as a result of mathematical mistakes, mistakes in applying accounting policies, or misinterpretation of facts or oversight. So it can be error of principle, error of omission, or it can be compensating error, or it can be clerical errors or arithmetical errors, any kind of error it may be. So errors took place or omissions took place in the previous financial years, but now they arise for rectification. So when now they arise for rectification, this can be your incomes or expenses. They are called as what? Prior period items. Means, say for example, 2 years back, our sales figure was understated. Understated means taken lower. So this year, you come to know that your sales was understated by 2 lakhs. So what you will do? 2 lakh of understatement of sale will be recorded now. So this will be recorded as an income or an expense. So technically as an income. Yes or no? But it is what? A prior period item. Because an income of 2 lakh has arisen because of error in the previous financial year. So this 2 lakh income that arises today will be considered as what? A prior period item. And a separate disclosure will be required. Please ignore the notes for the time being because these are exceptions to prior periods. We'll be discussing about this in the next 15-20 minutes. So just wait for these 2 points over here. Now, please have a look at now this is a simple chart which I've picked up from the module. Your net profit or loss comprises of ordinary, extraordinary, prior period item, changes in accounting estimates, and changes in accounting policy. So basically your profit and loss account comprises of these items. We saw ordinary, we saw extraordinary, we saw prior period. Now these are the 2, and even the changes in accounting policies have also been completed. Only one thing is left, that is changes in accounting estimate. So I want, before that, you people please have a look at the presentation of extraordinary items and prior period items in the statement of profit or loss. Now this is a vertical form of profit and loss account. Sales less variable cost, you get contribution, less fixed cost, you get EBIT. EBIT is earnings before interest and tax. Earnings before interest and tax. Then you subtract interest from it. So you get earnings before tax. Now here comes your logic of presentation. Earnings before tax, before extraordinary items or prior period items. This is your profits before adjusting these items. So when a particular user goes through your P&L account, he or she will come to know these are your profits before adjusting these items. Then you will do the adjustments of extraordinary items and prior period items, and even the exceptional items will be shown here itself. So exceptional items, extraordinary items, and prior period items all will be shown here. Then after adjusting these items, you will get earnings before tax after adjusting extraordinary items and prior period items. And then you subtract your taxes, you get your EAT, that is earnings after tax. So this is the logic of separate presentation or separate disclosure. Because say for example, you had a profit before tax, EBT, say you had 5 crores. I'm writing over here 5 crores. And there was a loss by fire because of which you lost 2 crore rupees. So 2 crore of loss. So 2 crore of loss is an extraordinary item. So 2 crore I will subtract from here. And then I will show that my earnings before tax after adjusting extraordinary item is 3 crores. So now what will happen if you don't give a separate disclosure of this 2 crores and record it somewhere in the P&L account and don't give a separate presentation for it? Then what will happen if a user goes through your financial statements and he will see your profit is only 3 crores? Your profit is only 3 crores. So he or she will say that you're not performing better. Your performance is not good, right? But if you give a presentation in such a way, then can I say the user can make a decision that, oh yeah, they have earned 5 crores as the profit, but because of the loss taking place, they lost 2 crores and now they are having a profit only of 3 crores. So the reduction in profit by 2 crores, is not because of their operational failures. It is because of some abnormal thing which took place in the enterprise. Right? So this is why we are not here to discuss income tax. Taxes are calculated on which earnings. So please ignore that. We are not discussing taxation over here. Not our point of agenda. Sorry. Now, so this is how you're going to give the presentation of extraordinary, exceptional, and prior period items in your profit and loss account. Right? These are all there in the PDF. So not to worry at all. This P&L account is already drafted. So what about expenses made for sanitization, mask, etc. due to COVID, which is now required? Sir, now it is the new normal, ordinary item only. And sir, this all sanitization, mask and all is going to run for the next 3 or 4 years. Trust me. They have created altogether a new market for this. Now, I don't know, but if you are aware or not, now Mumbai, again, the cases are surging like anything. So yesterday, Maharashtra, the state of Maharashtra recorded 9,000 cases in a day. Earlier, it was only 1,000 or 1,500 cases, but now they have recorded 9,000 cases. So again, the wave of COVID has again come back in Maharashtra, at least. I don't know about the other states, but it has come in Maharashtra again now. So let's hope for the best. Right. So here we complete the first part of the topic, that is ordinary items, the presentation with respect to ordinary items. Second, extraordinary items, and third, prior period items. Right now, I will be discussing with you people, that is your changes in accounting estimates. Sir, can we say prior period items are those which arise from error or omission? Definitely yes, but errors or omission not in this year. Errors or omission took place in the, see, what is the meaning? Prior period items. Prior period means what? These items don't belong to current year. These items belong to the previous years. Now, why they are belonging to the previous years? Because in the previous years, you did some error or omission. And because of that error or omission, now they are arisen. And now you're rectifying them. So when you rectify them, either an income can be recorded or an expense will be recorded. So these incomes or expenses are called as what? Prior period items. Right? Now we'll be starting with accounting estimates. Now, please understand what exactly are accounting estimates and what do you mean by changes in accounting estimates. Now, sir, please understand, whenever we are doing accounting, there are certain areas where the final outcome is not known to us. Means what will be the final amount of expenditure, or what will be the end of a particular transaction or end result of a particular transaction, we don't know. Means we say that these are uncertain in nature. But sir, we have to do the accounting. Even if the item is uncertain, it has to be recognized. So for recognizing certain, for recognizing some uncertain transactions, we have to make estimations. And transactions are recorded on the basis of the estimations. The best example for it, sir, when you are deciding the life of a particular fixed asset for the purpose of depreciation, the life is always estimated. For calculating the depreciation, you also estimate the scrap value. Now, why you say scrap value? Because you are not certain about the amount. You have estimated that you may fetch 5 lakh rupees after 10 years. Estimated useful life means you feel that it may run for 10 years. You cannot actually give in writing that this will definitely run for 10 years. No, it is always an estimation. So life is uncertain. So since there are certain items which are uncertain in nature, you have to do the accounting for them by considering certain estimates. So you make estimates. The best examples I gave you: estimating a life of an asset, estimating the scrap value, then estimating the NRV of inventory, cost or NRV, whichever is lower. What is NRV, sir? NRV is estimation. Estimating the fair value of investments on the balance sheet date, right? Then estimating the provision amounts. That is when you make provisions for certain expenses in your books of accounts. Those are what? Estimations. So these estimations are done because the amounts are uncertain. You don't know the final amounts. So you make estimations for them. And estimations are done on the basis of information which is available to you, or on the basis of the present situation or the present scenario. My point is, can these estimates that you're doing today, now say for example, you have provided for a certain expenditure in the books of accounts. You have created a provision as on 31st March for 5 lakh rupees for expenses. Can I say the actual expense can be greater than or less than 5 lakh rupees? Right? Say if it is greater than 5 lakh, say the actual expense incurred was 6 lakh. So can I say you have to further make a provision for 1 lakh rupees? So this further making a provision of 1 lakh rupees is called as what? Change in accounting estimate. So whatever estimates you made earlier, now they have changed. Why they have changed? Because the situation or informations might have changed. So estimations are based on the present situation. So if the present situation is changing in the future, or the conditions are changing in the future, the estimations can also change. So whatever accounting estimates you are making today can, I'm not saying compulsorily, but it can change in the future. So when it changes, it is called as a change in accounting estimate. And it can change depending upon the situations or conditions. I'll give you an example. Say on 20th March, I'll just write it somewhere over here. Say on 20th March, your car goes to garage, correct? And estimated expense is given at 12,000 rupees. Means the service agent, the what we say, one name they use for that person, advisor, service advisor. Yes, the service advisor, when you put your car for service, he gave you an estimation that 12,000 rupees will be the service cost, right? And your car will be delivered, say on 15th April 2021, and this is 20th March 2021. Now, can I say this falls in the next financial year? This falls in the next financial year. Now, technically, as on 31st March 2021, we will make a provision for repairs. And this provision will be made for 12,000. So my journal entry will be PL account debit 12,000 to provision for repairs 12,000. Right? This is the journal entry that I will make. And this provision for repairs is purely based on the estimation. This is purely based on the estimation as per given by the service advisor. But on 15th April, when the car was actually repaired, the actual expenses were rupees 20,000. Now, can I say you provided for 12,000, but the actual expense is now 20,000? Yes or no? So can I say you have to create a further provision for 8,000 to write off this expenditure fully? Right? So to create a further provision, you will again pass a journal entry, P&L account debit 8,000 to provision for repairs 8,000. Right? So this further provision that you created is called as effect of change in accounting estimate. Means your estimates changed. Earlier your estimation was 12,000, but now your actual expense is 20,000. So can I say your estimate has changed now? Because earlier you thought in 12,000 your car will be repaired, but now your car is actually repaired for 20,000 rupees. Right? So technically your estimation has changed by 8,000 rupees. This 8,000 is called as effect of change in estimate. This is called as what? 8,000 is effect of change in accounting estimate. Right? Now, my first question to you. Can this change? Definitely yes, because some extra repairs might have been taken place in your car. So extra expenditure has been incurred. So this is called as a change in estimate. And this 8,000 of further provision that you created is called as what? Effect of change in accounting estimate. Now my first question to you. As on 31st March, I provided only 12,000, but my actual expense was 20,000. So will this be called as an error or omission of the last year? Means the 8,000 that I'm recording now is because of the error or omission of last year? Definitely no, because it is an estimation and estimations are bound to change. Yes or no? So if you have already made any estimation in the last year, but those estimations change in the current year, such change in estimations are not errors or omissions. Hence, they are not prior period items. So that is my exception to prior period items. So if you remember, I told something that I leave. Please understand. Effect of changes in accounting estimates. Effect of changes in accounting estimates are not prior period items. So this effect of change of 8,000 rupees is not because of the error or omission that took place in the last year. Sir, last year I created a provision of 12,000 rupees depending upon the current situation. But as they repaired my car, they came to know that there are some 4 more faults in my car. So technically they have to make my car fault free and give it to me. So make it fault free, total 20,000 was spent. So that is not my error or omission of the last year. So always remember, whenever there is a change in accounting estimate, the effect of change means by whatever amount you're increasing or decreasing the provisions is not a prior period item. It is not a prior period item. That is first exception to prior period item. Then one more point, changes due to retrospective effects are also not prior period items. Example, arrears of salary or wages payable due to court's order or revision in pay from a retrospective effect. So when you increase the salary or wages of your staff with a retrospective effect means from a prior period you are changing the salary. Means say for example, on 1st March 2021, we decided that entire staff salary will be increased by 5,000 rupees with effect from 1st January 2020. Means on 1st March 21 you decided, but the increase will be given from 1st April 2020. So this is called as a retrospective effect. So my question is, from 1st January 2020 to Feb 21, whatever salary or wages I paid to my staff, was it incorrect? No, sir, it was not incorrect. That was correctly calculated and given. But now because we have decided to go for a retrospective effect, you cannot say that the salary paid at that time was wrong. That was absolutely correct. But this is only the management decision to give a retrospective hike, right? So never ever take a retrospective change as a prior period item because it is never your mistake. It is you who decided that, yes, I will give a retrospective change. So always remember, the salary hike due to retrospective effects or salary hike because of the court's order means something, some court cases between you and your union of employees for increase in salary, right? And the court gave a decision in favor of the union to increase the salary from retrospective 3 years. So the retrospective 3 years salary that the company will pay you is not an error or omission because company did not do any mistake. Company paid you proper salary, but it was the union who decided, who was willing to have a hike from last 3 years. So always remember, retrospective increase in salary or wages is never a prior period item. It is an exception. So technically we have 2 exceptions of prior period items. First, retrospective changes in salary or wages, and second, effect of changes in accounting estimates, because estimates are bound to change depending upon the present situation or scenario. So as per the old situation, you had created one estimate, but as per the new situation, the estimate is about to change. So as per old situation, you are correct. And now whatever is the new developments, you have to increase or decrease your estimations accordingly. So it is not a prior period item. Yes, Sujit.
Sir, imagine a scenario where salary to be given is say rupees 12,000. Okay, but it is recorded as 10,000. There is an error in the recording, but after some time there is a you said a policy came that 5,000 is retrospective effect. Okay, then how what will be the amount
sir,
to be
the
recorded?
error, sir, the error or omission that you made is a prior period item, sir. By whatever amount you buy, say 12,000 was salary, but you recorded 10,000. So 2,000 rupees is your prior period item. That is for sure.
Item. Okay.
Right. And the 5,000, which is a retrospective hike, is not a prior period item. It is a normal ordinary item because it is salary only. So it is what? Ordinary in nature.
Then the only that 2,000 is countable as
prior period
PPA.
item. Okay. Yes, prior period item. Right. So again, I'm going back to my example. So here I'll repeat my example again. Sir, when you gave your car into the garage, your estimation was 12,000 rupees. So you, as on 31st March 2021, you created a provision. Now, creating a provision is nothing but on estimation basis only. Provisions are always recorded on estimation, because the definition of provision is what you know. The liability is certain, but amount is uncertain. Liability is certain. See, I know I have to make a payment to the garage. That is certain. I have a liability to make a payment to the garage. That is certain. But can I say the amount is uncertain? So when the amount is uncertain, you create a provision. Right? But when the amount is also certain and liability is also certain, you record the actual liability. You record directly the outstanding expense. Means if as on 31st March, the garage bill is raised for 20,000, so no need to make a provision. It is an actual liability. So I will say outstanding garage bill 20,000 directly. But here in this case, I don't know the actual bill of the garage, because I will get the actual bill on 15th April, which is next year. So as on 31st March, I will say that yes, there is a liability for sure, but I don't know the amount. It is uncertain. That is why I create a provision on estimation basis. So I created an estimation as on 31st March of 12,000 rupees and recorded it in the P&L account. But on 15th April, when I received the actual bill, it was 20,000. So my estimation was wrong at this time. Now, estimation, I will not say it was wrong. It was calculated on basis of that situation. But now the current situation says that your expense is 20,000. So you have to increase your provision by 8,000 rupees. And this increase in provision by 8,000 is called as effect of change in accounting estimate. So there is an effect of change in estimate by 8,000 because you're increasing the provision by 8,000. And such effect of change is not a prior period item. So, sir, my next question is whether this item, whether this 8,000, the effect of change will be ordinary item or extraordinary item now. That is a question mark. Right? So please understand this in a very simple way. Your accounting estimate can either be presented as an ordinary or extraordinary items depending upon what transaction estimates are done or estimates are made. Are you understanding what I have written? I say that whenever you are creating an accounting estimate, whenever you are creating an estimate, that estimate means basically provisions. When you record these provisions in the books of accounts, right? They can either be ordinary item or they can be extraordinary item. It totally depends upon what transactions you are making the estimations. Means, for example, sir, you are creating estimation, you are estimating provision for bad debts. Provisions for bad debts are ordinary items. Provision for taxes, ordinary item. Provision for repairs and renewals, ordinary. Provision for repairs and maintenance, ordinary. But provision for loss by fire. Now, loss by fire is extraordinary. Loss by fire is extraordinary. So the provision that you create for it, extraordinary. Provision for refund of government grant. So refund of government grant is extraordinary. So whatever provision you create for it, extraordinary. Right? So it totally depends upon what type of transaction you are creating the estimation. If the transaction is ordinary, whatever estimate you are making on it is also classified as an ordinary item. Right? If the transaction is extraordinary and you are doing an estimation for that extraordinary item, that estimation will be classified in the books of accounts as extraordinary item. Example, ordinary items. What examples I can give? Sir, provision for tax, provision for RDD, that is your bad debts, provision for expenses, all ordinary. So what can be extraordinary. Sir, provision for abnormal losses, provision for all abnormal losses, then provision for refund of government grant, etc. Right? So whenever you are making an estimation for a particular item, if that item is ordinary, the estimation will also be ordinary. If that item for which you are making a provision is extraordinary, the estimate is also extraordinary. You have to reverse the provision. If the actual expenditure is less than the provision, you have to reverse the provision. That is called as excess provision return back. Say your expense, you thought that your expense will be 1 lakh, so you created a provision for 1 lakh, right? But your actual expenditure was only 75,000. No problem. 25,000 reverse. Reversal entry will be what? Provision to P&L. That is called as excess provision return back. That can happen, right? Are you understanding this point? Right? Now, one last point. Just wait for a minute. One last point. Now, sir, we learned that the accounting estimates can be ordinary or extraordinary item depending upon what you are making the provision or what you are doing the estimation. If you are doing an estimation for an ordinary item, the estimations that you're recording in the books of accounts will also be ordinary. If you are doing estimations for an extraordinary item, the estimations will be recorded in the P&L account as an extraordinary item only. Right? But sir, what will happen with respect now? Let us take this example only. Now, can I say the provision for repairs? Provision for repairs will be ordinary or extraordinary? You give me an answer. Provision for repairs of this car will be ordinary or extraordinary? Ordinary, ordinary, ordinary. Yes, definitely it is ordinary, sir, because it is for repairs. And repairs is ordinary activity for the business. It is not extraordinary. Because if you have assets, you're definitely going to get it repaired. Right? So these are normal, your day-to-day activity only. So technically, the provision that you created for repairs will be classified in the P&L account under the ordinary items only. Right? Now, my question is, when you will give the effect of change, that is when you will increase the provision by 8,000 rupees, where will this 8,000 now be classified? Ordinary or extraordinary? Are you understanding my question? You said that this 12,000 first estimation that you made will be classified as ordinary. Right? That is absolutely correct. Thumbs up. But my point is, when on 15th April, you decided that no, the actual expense was 20,000, so I have to increase the provision by 8,000 rupees. So first point is, this is not an prior period item. Means this increase of 8,000 rupees is not a prior period item. Reason, it is not the error or omission of last year. It was not your mistake in last year. Now, some people will say you should have created a provision directly for 20,000 in the last year. Na? But as per that situation, 12,000 was more than enough. So I created 12,000. But now the actual bill is 20,000. So is it my mistake? No. So it is not your error or omission. So this 8,000 that you're recording today, that is in this financial year, this 8,000 will not be treated as a prior period item. So the next question arises, then whether this will be 8,000 will be ordinary or extraordinary. Some people gave me ordinary, ordinary, ordinary. 1 or 2 gave me extraordinary. Maximum people have given me ordinary. And the answer is ordinary. Now, why it is ordinary? Sir, the original estimate of 12,000 was ordinary. The change in estimate will also be ordinary. If the original estimate was extraordinary, the change in estimate will also be extraordinary. So one thumb rule, change in estimate will be classified in the same way as the original estimate was classified. If the original estimate was classified as an ordinary item, the change in estimate will also be classified as an ordinary item. Means, for example, if you create provision for loss by fire, rupees 100. So this is technically extraordinary item. Why? Because it is provision for loss by fire. So this is an extraordinary item. So as on 31st March, you created this provision. On 30th June 2021, you decided that increase provision for loss by fire to rupees 120. So therefore, rupees 20 provision, therefore rupees 20 provision to be increased, correct? And this will be classified as what, sir? This will be classified as extraordinary item only, extraordinary item only, because the original estimate was extraordinary. So this change in estimation, the change in estimation by 20 rupees will also be extraordinary. I hope you're getting this point. Is there any situation where we can take first ordinary and then extraordinary? No, sir. If an item is ordinary for you, it will remain ordinary only. It cannot be like extraordinary. Earlier it was ordinary, now change it extraordinary. Not possible, sir. Sorry. What about the change due to retrospective effect? Already explained, the change due to retrospective effect is not extraordinary in nature. Sorry, it is not a prior period item. Now, retrospective effects of any item related to extraordinary, that will be again extraordinary. And if the retrospective effect is with respect to any ordinary item, then it will be about ordinary item only. Yes, Sutarsha.
Sir, I don't know if I could ask this or not. It may be silly. Sir, you said that everything, prepaid, prior period items or ordinary and extraordinary items all have the similar effects. But why we are classifying it?
Madam, to show the users the impact of these items, na?
Okay.
See, when I say an extraordinary item is taking place in your enterprise, means these are not in your day-to-day operations.
The significance
so if you're yes, because see, these items appear once in a blue moon and these are not related to your operating activities.
Yeah.
So if you have earned any gain out of this, and this, you know that this gain is earned only this year, you're not going to earn it every year from now.
Yeah.
So the investor should come to know that this gain is because of these items.
Yes, sir. Yes, sir.
That will give a true and fair view.
Yes, sir. Yes, sir. Thank you, sir.
Right?
Yeah.
Yes. Yes,
Sir,
Pooja.
actually, it is the concept of retrospective. Can you once again explain about that, sir?
See, retrospective effect means changing anything from the past. Changing any item from the past. Now, when you are increasing or decreasing, decrease though is not done generally, but increase is done from the past. So you cannot go and change the financial statements of past years. No, you have to change the financial statements. Whatever is the effect has to be given in the current financial statements only. That is why they are called as retrospective changes. I give you an example. We decided to change the salary from 1st January 2020. Right? And now it is March 2021. So technically, Jan 20 to March 20 falls in the year 1920, and April 20 to Feb 21 falls in the year 2021. So 2021 is not a problem. The problem is 1920. But can I say the balance sheet of 1920 is already finalized? So you cannot change the figures of the year 1920. So the retrospective changes of January to March will also be accumulated here itself in this financial statement. Now, technically what I say, these are the items of previous financial years which appear now. But these are not prior period items because these are not errors or omissions of your last years. These are because of the retrospective changes. Right? So retrospective changes doesn't amount that you have done a mistake in the previous years. No. That is why it is not classified as a prior period item. Now I'll read the point with respect to sir, if estimate is ordinary and if change in estimate amount is very high, then no, sir, it will still be ordinary only. You can give a disclosure. You can give a disclosure in the notes to accounts if the amount is material. But only the amount is very high, so that doesn't mean that it will become extraordinary. No. Now, please have a look at the paragraph that is given for accounting estimates. What it says, as a result of the uncertainties inherent in business activities, many financial statements items cannot be measured with precision, but can only be measured. Okay, sorry, but can only be estimated based on the latest information available. Estimates may be required, for example, for bad debts, for inventory obsolescence, means outdatedness of inventory. So you have to work out the NRV, estimated NRV, of which the estimates are based. Sorry, obsolescence or life of the asset. These are the examples which I already gave you. The estimates can be revised if changes occur regarding the circumstances on which the estimates are based, as a result of new information, more experience, or subsequent developments. So when you create an estimate, and if there are some further new information available to you and the situation or scenarios change, the estimates can be changed. And I'll give you one more example. You purchased a brand new plant and machinery, and you thought that this machinery will run for 10 years. So estimated useful life was 10 years. 2 years completed. Now the life is 8 years, can I say? Right? So in the beginning of the third year, you say that life is 8 more years. But flood took place, and your factory was underwater. It took 10 days for the water to drain. And after 10 days, when you switched on the machinery did not switch on, but only vapor and what we say, smoke came out from the machinery. And when you called up the technician told that, sir, I'll repair it, but I cannot guarantee the life of the machine now. It can run for 2 or 3 years maximum. Now, can I say in the beginning of third year, when you decided that life will be 8 years, but now because of the change in situation, the life can be only 3 more years now. So can I say the estimation changed depending upon the current situation or scenario? Right. So accordingly, you will depreciate your asset in the next 3 years only. Are you getting this point? So there will be a change in amount of depreciation, and the change in amount of depreciation can be considered as what? Change in estimate. Right. Now, depreciation is ordinary item. So when you change the amount of depreciation, that will again be classified as what? Ordinary item. Right. Now, please understand, note, revision of accounting estimate is not an extraordinary item or a prior period item. See, whenever you are changing an estimate, initially you don't declare it as an extraordinary or a prior period item. Changes in accounting estimates are initially not prior period nor extraordinary items. You have to check the effect of change. Whenever you are changing a particular accounting estimate, do not directly say that it is a prior period or an extraordinary item. No, it is not a prior period item for sure, because it is not the error or omission of past years. But you have to check the effect of change. Now, the effect of change will completely depend upon the original estimate. If the original estimate was classified as ordinary, the effect of change will also be classified as ordinary. If the effect of change was classified as extraordinary, then, sorry, if the original estimate was classified as extraordinary, the effect of change will also be classified as extraordinary. But directly don't say that a change in estimate is extraordinary or prior period. No. Initially, you will never say that. You have to first check the original estimate, and then you can say whether it is extraordinary or an ordinary item. Further, classification of change in estimates. Now, that is what I already discussed with you. Classification of change in estimate. The effect of a change in accounting estimate should be classified under the same classification in the statement of profit or loss as was used previously for the estimate. So the change, the effect of change should be having the same classification as it had for the original estimate. So if the original estimate was ordinary, the change will also be ordinary. If the original estimate was extraordinary, the change will also be extraordinary. Further, see, this is the explanation further. The effect of a change in an accounting estimate, which was previously included in the profit or loss from ordinary activity, is again included in the component of net profit or loss. Means if the effect of change in accounting estimate, which was previously included in the profit or loss from ordinary activities, is again included in that same component. Means if earlier it was ordinary, now it will again be ordinary only. But the effect of change in an accounting estimate, which was previously included in profit or loss as extraordinary item, is again reported as an extraordinary item only. I hope you're getting this point. How can you have a change in estimate on a prior period item? How can you have a change in estimate on a prior period item? Prior period item itself is an error, right? So whatever you asked is not correct. So here we complete technically with the concept or with the topic. Change in estimate could be exceptional. Change in estimate could be exceptional. Yes, if the size and nature of the transaction is too high, then it will require a separate disclosure. Definitely yes. Right? Now I'll go for the last part of the topic, which we have already discussed. Changes in accounting policies. In AS1, we have already discussed. Accounting policies can be changed if it is required by any law or by any accounting standard, or if the management is of the opinion that a change would give a better presentation of the financial statements. This is what we already learned. Then further they say that if the accounting policies are changed, you have to disclose three things. You have to disclose the fact of change. You have to disclose the reason of change. And thirdly, you have to disclose the quantifiable effect, right? Quantifiable effect should be disclosed only if it is ascertainable, means if it can be calculated. If quantifiable effect cannot be calculated, ignore the quantifiable effect. If quantifiable effect cannot be calculated, ignore it. Just disclose the fact and reason. Now, disclosing the fact and reason is compulsory. Disclosing the fact and reason is compulsory, but quantifiable effect is not compulsory. It has to be disclosed only if it is calculatable. Right? This is what we learned in AS1. Same point again appears. But what is important are these two statements, because on these two statements, questions were raised by the institute. Means these are the following two situations where this is not called as a change in accounting policies. Now, please understand these situations. Now, these are two situations where it is not called as a change in accounting policy. What this is, first I'll read the statement, then I'll explain it to you. The adoption of a new accounting policy. The adoption of a new accounting policy for events or transactions that differs in substance from the previously occurring events or transaction. Means, sir, we were doing certain transaction in our enterprise. For those transactions, we had a policy. Right? For every different type of transaction, we have different policies. So we were doing certain transactions, and for those transactions, we had a policy. Now we decided that we will switch the transaction itself. Means we will not do the old transactions now. We will rather enter into new transactions. And for the new transactions, we will have a new policy. Right? So this does not mean that there is a change in accounting policy, because the transaction itself is new. So for a new transaction, you have a new policy. Right? For an existing transaction, if you have a new policy, then I say this is a change in policy. But if you are skipping the old transaction and altogether entering into a new transaction, and for that new transaction, you make a new policy, that is not called as a change in accounting policy. Right? The example given over here is, example, introduction of a formal retirement gratuity scheme by an employer in place of ad hoc ex gratia payments to employees on retirements. Means in this company, in the previously, ad hoc ex gratia payments were given on retirement. Ad hoc ex gratia means finally on retirement, a lump sum amount will be paid to you. Right? And that will be completely depending upon the nature of your service and how did you perform in the enterprise, what was your contribution to the enterprise. Ad hoc payment. So for some people, 5 lakh was given. For some people, 10 lakh was given. For some people, 7 lakh was given. So we had a policy on how to work out the ad hoc ex gratia. Right? Now, if I change the policy with respect to ad hoc ex gratia only, means earlier there was one policy for calculating ad hoc ex gratia. Now we decided to calculate the ad hoc ex gratia in a different manner. So this would be called as what? A change in accounting policy. Because for a same transaction, I have switched the policy. right? But in this case, we have switched from ex gratia itself. Now we say that we will not have ex gratia. We will have a proper gratuity plan as per the Payment of Gratuity Act. So can I say the transaction itself is changed? So for formal gratuity, you will make a policy. For formal gratuity plans, you will make a policy. This is not called as a change in accounting policy. I hope you are understanding this. Right? The first situation. Second situation, adoption of a new accounting policy for events or transactions which did not occur previously or that were material. Means you have formed a policy employees after retirements. Before we never gave pensions, we gave only ad hoc ex gratia. So now ad hoc ex gratia shifted to formal gratuity, but we also decided that we will give pensions. Now, can I say giving pension is an event or transaction which is new for the enterprise? So for these pensions, you will make some policies. So these are not called as change in policies. Altogether, a new policy has been adopted. Right? Or where material means earlier they were immaterial. Earlier those events or transactions were immaterial, but now they have become material. And since they have now become material, you have a policy made for them. So that means it is not a change in accounting policy. See, ad hoc ex gratia is nothing but lump sum payments at the time of retirement. It is not governed by any law or any rules, but payment of gratuity is governed by the Payment of Gratuity Act. So people used to follow ad hoc ex gratia rules earlier, but many have shifted from ex gratia towards gratuity. So shifting from ex gratia to gratuity is altogether shifting from an old transaction to a new transaction. So when the transaction itself is new, whatever policy you are drafting for the new transaction doesn't mean that it is a change in accounting policy. Right? So here we technically complete our topic AS5. And now we have to solve the questions from this topic. Anybody with any query in the next 5 minutes, please raise it and then we'll go for questions. So 5 minutes windows for doubts. Anybody wants to raise a query, please. GPFS I already gave, na? General purpose financial statements. GPFS is general purpose financial statements. In the first lecture only I gave the full form. Anybody with any doubts or queries still here or with any part of the topic, please raise it. See, if you have still not got the difference between policies and estimates, sir, policies are what? Policies are the rules or regulations that you adopt for preparing financial statements. And estimates you do for accounting, that is where certain areas where the amounts are uncertain. So you try to estimate the figures. See, I told you, estimates are generally made for provisions, for creating provisions in the books of accounts. You estimate the amounts. Why you estimate? Because you know that the liability is certain, but the amount is uncertain. So wherever the amounts are uncertain, you make estimations. See, nobody can estimate the life of any asset. So you estimate the life.
Sir?
Yes.
Sir, if you told for extraordinary item, exceptional item and all should be separately disclosed, no, sir? These
Yes.
items. Is there any order to disclose that? Like extraordinary item should come first and exceptional item should come second in notes, sir?
No, nothing as such. In the profit and loss account, it should be coming one below the other after your earnings before taxes.
Okay, sir.
Once you adjust your interest cost, then you will adjust all these extraordinary prior periods and exceptional items.
Yes, sir. In notes, it's our wish, no, sir?
In notes?
it's our wish to disclose anywhere, no, sir? From first or second?
In notes to accounts, na?
Yes, sir.
In
It's
notes
our
to
wish.
accounts, you have to. It is your wish, and you have to
Yes, sir.
disclose it at one place only, sir.
Okay,
Don't
sir.
disclose it everywhere. Don't scatter
Okay.
it.
Okay, sir.
Kindly explain the second situation in accounting. Arey sir, second situation is what you are coming with altogether a new type of transaction in your enterprise. So if you are coming with a new type of transaction in your enterprise, whatever policy you are picking for that new transaction, how can it be called as a change in policy? Because it is altogether a new policy coming in for a new transaction. So it is not a change in policy. It is called as adopting a new policy. Yes. Anybody else with any further doubt or query? Yes, Rajesh.
Sir, very good evening, sir.
Very good evening.
Sir, if suppose a fire occurred in current year, and the claim we received from the insurance company after 1 or 2 years, then the insurance claim we received after a subsequent year or some 2 years, how will
Sir, it is not a prior period item. First of all, it is not a prior period item.
Yeah, that only I wanted to know.
Right? It is not a prior period item because it generally happens that insurance claims you get it after 1 or 2 years. So it is not a prior period item, but insurance claim itself is an extraordinary item. So it will be recognized as an extraordinary item in the statement of profit or loss.
Okay, sir. Thanks.
But not as a prior period item. No, because it was not your error or omission.
So in that case, we can understand like for prior periods, only rectifications are assumed. Only rectifications
Only
occurred
rectifications.
Errors of
Because
past
prior
years.
period items are nothing but errors or omissions of last years. So technically errors or omissions of last year will come now when you rectify them.
Okay, sir. I got it.
Right?
Yes.
Yes, Pooja.
Sir, can you explain the second point of which are not the changes in accounting policy?
Which are not the change in accounting policy means? I just now explained now, where were you? The second point, the adoption of new policy. Please read, it is self-explanatory. It is self-explanatory. What it says, adoption of a new policy for events or transactions which did not occur previously means new transaction coming in your enterprise, new type of transaction you are doing. And for new type of transaction, you will have a new policy. So how can it be called as a change in policy?
Okay.
Right? You are doing some transaction which is new for your enterprise.
Okay, sir.
So you will have an altogether new policy. So it is not a change in policy.
Okay, sir. Thank you.
Yeah. So let us now go for the questions. We'll go for the questions now. Now questions we'll be doing from the JKSC material itself. So I think everybody has their JKSC material with them. I hope people are having their JKSC material. Okay. Now, we'll discuss once again, sir, how to present the answers in exam. We have already talked about this in the previous lectures also. I'll explain this once again in the. So generally, if you have a case study type of question, case study type of question means there is a given situation and respect to the relevant provisions of the accounting standard. So always try to give your answer in 3 paragraphs. Para number 1 will be always the introductory para, which will be first starting with the number and name of the accounting standard, followed by the provision with respect to which the question is related. Means if the question is related to a prior period item, so you will write the definition of a prior period item and you will say a separate disclosure is given for a prior period item. If the question is based on change in accounting estimate, then the provision you will write what are estimates and how then estimates can be changed. If a question is based on change in accounting policy, then you have to write the provision with respect to changes in accounting policy, that why it is changed and what are the disclosure requirements. So that always becomes your first paragraph, and you cannot have a common first paragraph for all type of questions coming from that AS. For different situations, you will have the different paragraph. Means if a question is based on prior period item, you cannot write the paragraph for extraordinary item, right? So you have to write the provisions accordingly with respect to what the question is. Second paragraph will be the explanation of the given situation. You will explain the given situation in the second paragraph. And third paragraph will be the conclusion. Conclusion, if they are asking you your opinion, or rather I would say they are asking you whether the treatment done is correct or not, then you will have a conclusion that the treatment given is correct as per AS5 or the treatment given is not correct as per AS5. That is your conclusion. Now, it is not practically possible that in every answer you will have a conclusion. So if conclusion is possible, you have to give it. If not, ignore. Then only give the 2 paragraphs. That will be more than sufficient. Right? So let us have a look at the questions now. Question number 1. Advise B Company Limited about the treatment of the following in the financial statements of accounts for the year ended 31st March 2012. So you have to give an opinion as on 31st March 2012 for this transaction. The company finds that the stock sheets as on 31st March 2011, that is last year's stock sheet, had included twice an item, the cost of which was 55,000. So technically in the last year's closing stock, 55,000 was recorded twice, which in this year you have found out. What is this situation? Ordinary, extraordinary, or prior period? I'm getting answers. Prior period. Yes, this is a prior period item. This is an error which took place in the last year's closing stock. And this year you come to know that error had taken place. So definitely you are going to rectify this. Right? So when you rectify this, what you have to do? Sir, can I say if last year my closing stock was valued upward, I had shown higher profits in last year. So this year rectification means I have to reduce my profits, right? Reduce my profits and reduce the value of inventory by 55,000 rupees. So technically my journal entry over here will be profit and loss account debit to inventory or to opening stock, as the case may be. It is profit and loss account debit to opening stock. That will be my journal entry for the second year. That is for rectification. But sir, here we need not give any journal entry. We just have to give the treatment. So what will be the treatment? Sir, treatment first. Now this question, can I say, is based on prior period items. So my first paragraph, as per AS5 net profit or loss for the period, blah, blah, blah. I will first write the definition of prior period items. That will be my first paragraph. Followed by in the second paragraph, I will tell how this will be rectified. So how this will be rectified? Sir, I will reduce the value of opening stock by 55,000 and debit my profit and loss account accordingly. And the debit of the profit and loss account will have a separate disclosure. Right? The debit that you're going to give in the profit and loss account will be in the form of a prior period item. So it will be requiring what? A separate disclosure. So let's have a look at the question for this, for the solution. Everybody please focus on the solution. My first paragraph, as per AS5, comma, prior period items or incomes or expenses which arise in the current period as a result of errors or omissions in the preparation of financial statements of one or more prior periods. So technically, I have given the definition of prior period items in the first para. That is my provision paragraph. Now comes the given situation. Hence, rectification of error in opening stock valuation, because last year closing stock becomes current year opening stock. So hence, rectification of error in opening stock valuation is a prior period item. Definitely yes. The amount of 55,000 shall be deducted from the opening stock in the profit and loss account for the current year and should also be charged. Charged means debited. Charged means debited. Charged means debited as a prior period adjustment in the profit and loss account below the line. Below the line means shown separately. I have already shown you the P&L account. Below line item means first you calculate your profit before taxes. and then you will adjust the prior period items. So that is called as below line items. And finally, AS5 requires separate disclosure of prior period item with their nature and amount. So we will also give a separate disclosure for this. Separate disclosure as in the profit and loss account, you have to write it separately. Plus in the notes to accounts also, you will give a separate disclosure. In the notes to accounts, you will write the nature. What is the nature? Rectification of error, that is reduction, that is upward valuation of closing stock last year. So current year it is reduced by 55,000. So nature and amount will also be disclosed separately in your notes to accounts, as well as it will have a separate presentation in the profit and loss account also. So a simple question. And I think the solution for this question is printed. And apart from this, no other solution is printed, if I'm not wrong. Only question number 1's answer is printed. Okay, other solutions I have made. So you can take a note from the solutions that I have already given with me. Any query with question number 1? Any queries with question number 1? Shouldn't we show the disclosure also in our answer? No, not required. Sir, the journal entry over here will be P&L account debit to opening stock. So value of opening stock has to be reduced. The value of opening stock has to be reduced. And when you reduce the opening stock means you have to credit the opening stock. So if you want to credit the opening stock means what will be debited? Sir, the P&L account only has to be debited. So in your simple final accounts term, I will say that reduce it from trading debit and show it in P&L debit. In your simple final accounts logic. Or credit the trading account, debit the P&L account. As simple as that. In your final accounts logic, I'm talking. Fine. Am I audible now? Okay. So I'll go for the second question now. Just wait for the screen sharing to start. Screen sharing will start. There was a loss of connection. Yeah, it is now correct. Yeah. I'll go for the second question. Right? What it says, a limited company created a provision for bad and doubtful debts. A limited company created a provision for, now creating a provision means estimations. So you have done an accounting estimate. So you have done an accounting estimate with respect to provision for bad and doubtful debts at 2.5% on debtors in preparing the financial statements for the year 10-11. Subsequently, on a review, actually this should not be 10-11, right, to be more correct. So, okay, fine. Subsequently, on a review of the credit period allowed and financial capacity of the customers, the company decided to increase the provision to 8% on debtors as on 31st March 2011. So already we had created 2.5%. But on reviewing the credit period allowed and the repayment made by the customers, now we have decided that 2.5% will not be enough. We should actually increase it to 8%. The accounts were not approved by the board of directors till the date of decision. Now, if accounts are not approved by the board of directors means you can make this change accordingly. Because once your financial statements are approved by the board of directors, then you cannot make such changes. Then these changes have to be accounted in the next year, not in this financial statements. We'll be learning about this in detail tomorrow when we start with AS4. We'll be starting with AS4 tomorrow. While applying the relevant accounting standard, can this revision be considered as an extraordinary item or a prior period item? Now, sir, please understand. Yes, one answer I got from Sujit is absolutely correct. Now, please understand, sir. Can I say this is a question based on changes in accounting estimate? And we already discussed that changes in accounting estimates cannot be directly said as an extraordinary or a prior period item. Right? Now, what we have to decide is the effect of change, that is increasing the bad debts from 2.5% to 8%, is with respect to an ordinary item or extraordinary item. It is ordinary item, right? So in this case, the effect of change will be treated as an ordinary item, not an extraordinary nor a prior period item, right? So my first paragraph in this question will be based on accounting estimates. I will first talk about accounting estimates in the first paragraph, right? Then I will say that a change in accounting estimate is not a prior period nor an extraordinary item. And then I will explain the given situation. So let us have a look at the solution for this. Solution for question number 2. What it says, as per AS5, the full name I have given, net profit or loss for the period, prior period items and changes in accounting policy, comma. The preparation of financial statement involves making estimates, which are based on the circumstances existing at the time when the financial statements are prepared. It may be necessary to revise an estimate in a subsequent period if there is a change in the circumstances on which the estimation was based. Revision of an estimate by its nature does not bring the adjustment within the definitions of a prior period item or an extraordinary item. So changing an estimate cannot directly be called as a prior period or an extraordinary item. This is my first paragraph, where I have talked about accounting estimates and changes in accounting estimates. And on a basic level, changes in accounting estimates are not prior period or extraordinary items. This is my first paragraph. Following the given situation. In this case, a limited company created 2.5% provision for doubtful debts for the year 10-11. Subsequently, in 2011, the company revised the estimates based on the changed circumstance and wants to create 8% provision. As per AS5, this change in estimate is neither a prior period nor an extraordinary item. However, as per AS5, a change in accounting estimate, which has a material effect in the current period, should be disclosed and quantified. Any change in the accounting estimate which is expected to have a material effect in the later periods, later period means in the next financial years also, then that also should be disclosed and quantified. So here, since the provision is with respect to bad debts, which is an ordinary activity, this is not classified as an extraordinary or a prior period item. So this is technically an ordinary item only, right? But if the amount is material, then you can give a separate disclosure. But if the amount is not that highly material, no need of giving a separate disclosure. So this is a solution for question number 2. Right? You can just take a note of this. So now we'll go for the question number 3, I think. Third, no, we are going the 4th and the 5th one now. 4th and the 5th one. 4th question. Question number 4. Now, why is a student sending question mark? Question mark for what? Okay. Question number 4. STB Limited makes a provision for expenses worth 7 lakh rupees for the year ending 31st March 2011. But the actual expense during the year ending 31st March 2012 comes to rupees 9 lakh. against provision made during the last year. So can I say this question is similar to my garage example? So in my garage example, I made a provision for 12,000 rupees, but the actual expense came to 20,000 rupees. So technically I created a further provision for 8,000. So here also I created a provision for 7 lakhs in last year. That is as on 31st March 2011. But in the current year, when the actual expense was incurred, the amount was 9 lakh rupees. So can I say I have to create a further provision of 2 lakhs? So this further provision of 2 lakhs, they are asking, state with reason whether the difference of 2 lakhs is to be treated as a prior period item. Is this a prior period item or is this an effect of change in accounting estimate? It's the effect of change. And effect of change in accounting estimates are not prior period items. Right? So how you will present your answer? Sir, here I will write 2 provisions. First is with respect to accounting estimates and why they can be changed. Second, I will also define prior period items reason in the question they're asking me whether it should be treated as a prior period or not. So I should tell the examiner that what prior period items are. So first I will write about accounting estimates, then I will write about prior period, and then I will say that this 2 lakh rupees is an effect of change in estimate. And this is not an extraordinary, not a prior period item. This is an ordinary item because it is with respect to repairs, right? Provision for expenses. Basically, it is normal expenses. So these are ordinary in nature, right? So let's have a look at the solution for this. Question number 4. Now the question number 4, the point which I have cancelled need not be copied. That was not required. So I just cancelled it off, right? Not it says, as per AS5, net profit or loss for the period, prior period item and changes in accounting policy, the name and number. As a result of the uncertainties inherent in the business activities, many financial statements items cannot be measured with precision, but only can be estimated. The estimation process involves judgment based on the latest information available. So can I say my first paragraph is nothing but definition of accounting estimates, to be more correct? Then estimates may have to be revised if changes occur regarding the circumstances on which estimate was based, or as a result of new information, more experience, or subsequent development. So I talked about change in estimate also. Then I'm talking about prior period items. Prior period items are incomes or expenses which arise in the current period as a result of errors or omissions in the preparation of financial statements of one or more prior period. So technically I have defined prior period also. So 3 things I have given. First, accounting estimate. Second, changes or revision in accounting estimates. Third, prior period item. Prior period item I have defined because in the question they are asking me whether this 2 lakh is a prior period or not. So they're specifically focusing that this 2 lakh is prior period. So I have to first define prior period also. Now comes the given situation. Thus, the revision of an estimate by its nature, that is the difference of 2 lakhs, is not a prior period item because it's an exception to prior period item. So never treated as a prior period item. Therefore, in the given case, expenses amounting to 2 lakh, that is 9 lakh minus 7 lakh, relating to the previous year, recorded in the current year, related to the previous year, but it is recorded in the current year, should not be regarded as a prior period item, comma, it is just a change in accounting estimate. Or rather, you should write it is just a, it is just a, here you write, effect of change in accounting estimate. Right? So it is not a prior period. And you can also write it is not a prior period nor an extraordinary because it is just provision for expense. Right? So last year you recorded 7 lakh. This year you are recording how much? 2 lakh more. So 2 lakh that you're recording this year is actually belonging to the provision of last year only. But since it is recorded in this year, it is just a change in estimate. It is not a prior period item. Right? So please take a note of this. Question number 4. Now let us go for the 5th question. Let us go for the 5th question. Yeah. Question number 5. What it says, a similar question. It is similar to question number 4. A company created a provision of 75,000 for staff welfare while preparing the financial statements for the year ended 2010-11. On 31st March, in a meeting with the Staff Welfare Association, it was decided to increase the amount of provision for staff welfare to 1 lakh rupees. So earlier you had created a provision for staff welfare expense for 75,000, and now you decided to increase it to 1 lakh, right? And the decision is taken after 31st March. But the accounts were approved by the Board of Directors on 15th of April. So technically the decision to make the change was done before the accounts was finalized by the Board of Directors for the same year itself. So this can be incorporated in the same financial statements only. Explain the treatment of such revision in the financial statements. Now, can I say this is a change in estimate? Means earlier you created a provision for 75,000 for staff welfare, but now you are deciding to change it to 1 lakh rupees. So can I say you are going to increase your provision by 25,000 rupees? And this increase in 25,000 rupees is called as a change in accounting estimate. It's called as what? A change in accounting estimate. So it is not a prior period item. Will it be an extraordinary item? No, because it is with respect to staff welfare. And staff welfare are always ordinary activities. So this is not a prior period item, nor an extraordinary item. This will be classified as what? A normal ordinary item only. So here they are asking you the treatment of such change. So what we will do is, sir, first paragraph, can I say we will write about estimations? We'll write about accounting estimates. Then we'll write about changes in accounting estimates. And here I will also write that a change in estimate completely depends upon the original estimate for its classification. Means if the original estimate was classified as ordinary, the effect of change will also be classified as ordinary. If the original estimate was classified as extraordinary, the effect of change will also be classified as what? An extraordinary item. So let's have a look at the solution for this question. Question number 5. Now what it says, as per AS5, net profit or loss for the period, the name, the change in the amount of staff welfare provision amounting to 25,000 is neither a prior period nor an extraordinary item. It is a change in estimate which has been occurred in the year 10-11. Now, as per the provisions of the standard, normally all items of incomes and expenses which are recognized in a period are included in the determination of net profit or loss for that period. This includes extraordinary items and the effect of changes in accounting estimates. However, the effect of such a change in an accounting estimate should be classified using the same classification in the statement of profit or loss as was used previously for the estimate. So here, since it is normal staff welfare expense, it is not considered as an extraordinary item, and anyhow changes in estimates are not prior period. So here we classify them as not prior period and not extraordinary, but we classify them as ordinary items only. So this solution you will provide for question number 5. Right now, apart from this, I will also be completing one question which was left from chapter number 1. Right. So if a student is appearing again, say for coming example in the tomorrow morning batch. So in the morning batch again, anyhow, I'm going to do that question. So now I'm doing this question. But a student is tomorrow who is coming in the evening batch, they have to compulsory attend this question now, because again tomorrow in the evening batch I'll not be doing this question. I think one question was left from chapter number 1. So you please take a note of this solution in the next 5 minutes, and then I will complete that one question left from chapter number 1, because it is related to this same provisions only. Question number 3 in AS1. Yes, because that is based on the change in accounting estimate concept, because some provision amounts are changed over there. So everybody please, we'll be doing now, see, I hope you have completed with question number 5. I have to quickly now, please take a screenshot, whosoever is still pending, because I've given you ample time to copy. I have to complete one more question in the next 7 to 8 minutes. So I want please you take the screenshot. In the next 5 seconds, I'll be changing the screen. So please take a screenshot. I'm changing the screen now. Now, one question was pending from your first accounting standard, which was having a relation to this chapter. Question number 3. Question number 3. Tomorrow I'm starting with AS4. I already told. After completing this topic, we'll be starting with AS4 tomorrow. Question number 3. What it says, ABC Limited was making provision for non-moving stocks based on no issues for the last 12 months up to 31st March 2015. So they were making provisions for non-moving stocks. There were some slow-moving stocks which were not sold. So obviously there will be the diminution in the value of them. So they have made a provision for decrease in the value of those stocks based on no issues. Based on no issues for last 12 months means they checked which items are not issued in the last 12 months. On the basis of the cost of those items, they created a provision. But the company wants to provide during the year ending 31st March 2015 based on technical evaluation. The total value. Now, what they are doing is first they created a provision based on no issues for the last 12 months. And now they want to provide based on technical evaluation. So they are actually changing the way of calculating the provision amount, right? The total value of the stock is 100 lakhs. Provisions required based on 12 months issue is 3.5 lakh. And provisions required based on technical evaluation is only 2.5 lakh. So as per the old method of calculation, 3.5 lakh provision was required. And as per the new method of calculating, only 2.5 lakh is required. Does this amount to change in accounting policy? Can the company change the method of provision? Now, sir, please understand. Here, the policy is that you have to provide for no moving stocks, right? And the calculation of these amounts are called as estimations. So here, it is not a change in policy, rather it is a change in estimate. Means you are changing the estimations. Earlier, you were estimating based on the no issues for last 12 months. And now you are estimating on the basis of technical evaluations. But you are creating a provision for non-moving stocks. So technically, you are not changing any policy. You are just changing the estimations. So this is a change in accounting estimate. And the effect of change is 1 lakh reduction in provision. And sir, if you are having a total stock of 100 lakhs, and if you are changing the provision by 1 lakh, can I say it is completely immaterial? And if it is immaterial, it will never require a separate disclosure also. Right? So let's have a look at the solution for this. Let's have a look at the solution for this. I think it is a printed solution in your material. Yeah, question number 3. What it says, the decision of making provision of non-moving stocks on the basis of technical evaluation does not amount to change in accounting policy. Requirement to provide for non-moving stocks may be said as an accounting policy. Means when you create a provision, you have decided to create a provision. Deciding to create a provision is a accounting policy. But on what amount the provision should be created, that is called as an estimation. So here you are changing the amount, you are changing the estimations. So it is not a change in accounting policy. It is a change in accounting estimate, to be more correct. Requirement to provide for non-moving stocks may be said as accounting policy, but the basis for making the provision, the basis for calculating the provision will not constitute an accounting policy. It will be considered as an accounting estimate. Further, the method of estimating the amount of provision may be changed in case of a more prudent estimate can be made. Means situation to situation, the estimations can change. In the given case, considering the total value of stock, the change in the amount of required provision of non-moving stock from 3.5 lakh to 2.5 lakh is also not material, because only 1 lakh rupees you have to reduce the provision. And the total value of your stock is 100 lakhs. So it is immaterial. Disclosure can be made for such change in the following lines by way of notes to accounts in the annual accounts of ABC Limited for the year 14-15. Now, what disclosure you will give? the company has provided for non-moving stock on the basis of technical evaluation, unlike preceding years. So in the preceding years, you did on the basis of no moving. And this year you decided to go for technical evaluation. Had the same method been followed as in the previous year, the profit for the year and the corresponding effect on the year-end net assets would have been higher by 1 lakh rupees. Now what they say, had the same method been followed as in the previous year, the profit for the year and the corresponding effect on the year-end net assets would have been higher by 1 lakh. So in the last year, you created a provision based on 3.5 lakh. And current year, you are creating a provision based on only 2.5 lakh. Right? So if in the last year also, you had created a provision based on 2.5 lakh only, right? So the profit of that year, the profit of last year would have also been greater by 1 lakh. And your value of your assets would have been greater by 1 lakh because 1 lakh provision would have been lesser in the last year. So what they say, had the same method been followed as in the previous year, the profit for the year means the technical evaluation if followed in the previous year, the profit for the year and corresponding effect on the year-end net assets would have been higher by 1 lakh. Means if you followed technical evaluation in the last year also, then your last year's profit and your net assets would have been greater by 1 lakh rupees. Because if your provision is only 2.5 lakh means your profit would have been increased by 1 lakh and eventually your net assets would also have increased by 1 lakh. Right? Now, this amount of 1 lakh is not material, right? But there is a change in estimation taking place. So they have told you, if you want, if you are giving a disclosure, then in such a manner you can disclose. But since it is immaterial, you can avoid the disclosures also. That will be up to you. But if you are disclosing, it should be disclosed in such a manner. Right? But if it is immaterial for you, and obviously this 1 lakh is immaterial, we can ignore this disclosure also. But if the disclosure is given, then it has to be disclosed in this particular manner. Just a minute. Right. So this will be the solution for question number 3 of AS1. And I think this is already printed in your JKSC material. So it is already printed. So you can take a note from there itself. Right. So here we conclude with our today's session. Tomorrow we have to complete 2 questions of AS5 and then followed by AS4. We'll be starting and completing AS4 tomorrow. Right. So we'll take a sign off now. We'll end up the session. See, provision for non-moving stocks is nothing but reduction in the value of your inventory. That is anyhow ordinary nature only. So no need to go for extraordinary items as such. Yes, Gunjan.
So AS4 PDF notes are not uploaded.
Because I have, we generally use the JKSC material only. We generally use the JKSC material only because these all, whatever I've written over here, will again be covered in AS29. So we will be using this same material. See, this is the same JKSC material which is there. Only the extra points that I have put over here, you can copy it down tomorrow itself on screen.
All right. Okay.
Right?